What really happens when interest rates start falling? And why does everyone suddenly start talking about it? Lower interest rates don't just affect banks. They impact loans, savings, investments, and even the overall economy. Today, we're breaking down what falling interest rates mean for borrowers, investors, businesses, and everyday people. You'll discover who benefits, who might lose, and how you can position yourself smartly when rates begin to drop. Today, we will talk about what happens when interest rates start falling. So before we start, make sure to hit the like button and subscribe to my channel. 1. Borrowing becomes cheaper. When interest rates start falling, borrowing money becomes cheaper for individuals and businesses. Lower rates mean banks charge less interest on loans such as mortgages, car loans, and business financing. This encourages people to take loans for buying homes, expanding companies, or investing in new projects. Cheaper credit increases spending and investment, which can stimulate economic growth. Businesses often use lower borrowing costs to expand operations, hire more workers, or upgrade equipment. Consumers may refinance existing loans at lower rates, reducing monthly payments and increasing disposable income. However, while borrowing becomes easier, lenders may tighten standards if economic uncertainty exists. Overall, falling interest rates are often used by central banks to encourage economic activity during slowdowns. By making money more affordable to access, policymakers aim to boost confidence, increase consumption, and prevent deeper recessions from taking hold in the broader economy. 2. Mortgage and housing market growth. Falling interest rates usually have a strong impact on the housing market. When mortgage rates decline, home loans become more affordable, allowing more people to qualify for financing. This increases demand for homes, often pushing property prices higher. Existing homeowners may refinance their mortgages to secure lower payments, freeing up extra cash for other expenses. Builders and real estate developers may increase construction activity due to rising demand. Lower rates can create a competitive housing environment where buyers act quickly to lock in favorable terms. However, if demand grows too rapidly, it may lead to higher property prices and affordability concerns. Housing plays a significant role in the economy, influencing construction jobs, furniture sales, and home improvement industries. As interest rates fall, the ripple effect across related sectors can significantly stimulate overall economic activity and consumer confidence in financial markets. 3. Stock market reactions. When interest rates decline, stock markets often respond positively. Lower rates reduce borrowing costs for companies, potentially increasing profits and expansion opportunities. Investors may shift money from savings accounts and bonds into stocks, seeking higher returns. As bonds offer lower yields during rate cuts, equities become more attractive. This increased demand can drive stock prices upward. Growth sectors, particularly technology and consumer discretionary companies, tend to benefit significantly. However, falling rates may also signal economic weakness, which can create volatility in markets. Investor sentiment plays a crucial role in determining whether markets rally strongly or cautiously. Additionally, lower rates increase the present value of future earnings, boosting stock valuations. While rate cuts can support financial markets, excessive or prolonged reductions may raise concerns about inflation or asset bubbles. Overall, stock performance during falling rate environments depends on broader economic conditions and investor expectations. 4. Impact on savings and deposits. While borrowers benefit from falling interest rates, savers often face disadvantages. Banks reduce interest paid on savings accounts, fixed deposits, and certificates of deposit. This lowers returns for individuals who rely on interest income, particularly retirees. As savings yield less, people may seek alternative investments to maintain returns, potentially taking on more risk. Reduced incentives to save can increase spending, supporting economic growth. However, lower deposit rates may discourage conservative financial planning. Financial institutions adjust deposit rates to maintain profit margins as central bank rates decline. For individuals focused on capital preservation, falling rates can be frustrating. Savers may need to diversify investments into bonds, dividend stocks, or other income-generating assets. Ultimately, while falling interest rates stimulate borrowing and spending, they create challenges for those depending on steady interest income from traditional savings products. 5. Business expansion and employment. Lower interest rates make it easier for businesses to access affordable financing. Companies may borrow funds to invest in expansion, research, and new product development. Reduced financing costs improve profit margins and encourage hiring. Small and medium-sized enterprises often benefit significantly from rate cuts, as they rely heavily on bank loans. Increased business activity can lead to job creation and wage growth. However, if falling rates reflect economic distress, businesses may remain cautious despite cheaper credit. Confidence plays a key role in determining whether companies act on lower borrowing costs. Investment in infrastructure, technology, and innovation often rises during accommodative monetary periods. Over time, this can strengthen productivity and long-term growth. Falling interest rates are therefore a powerful tool for encouraging corporate activity, boosting employment, and stimulating economic momentum during periods of slow growth. 6. Currency value and trade. Interest rate reductions often weaken a country's currency. Lower rates make domestic investments less attractive to foreign investors seeking higher yields elsewhere. As capital flows outward, the currency may depreciate. A weaker currency can benefit exporters by making goods cheaper for foreign buyers, potentially improving trade balances. However, imports become more expensive, which may increase inflationary pressures. Countries heavily dependent on imported goods may experience higher consumer prices. Currency fluctuations also affect multinational companies, tourism, and international investments. Central banks carefully monitor exchange rate movements when adjusting interest rates. While a weaker currency can support economic growth through exports, excessive depreciation may cause financial instability. 7. Consumer spending boost. Falling interest rates typically encourage consumer spending. Lower loan payments and refinancing opportunities increase disposable income. People may feel more confident about making large purchases such as homes, vehicles, or appliances. Credit card interest rates may also decline, reducing the cost of borrowing. As consumers spend more, businesses experience higher sales, leading to increased production and employment. Consumer confidence often rises when borrowing costs are manageable. However, excessive borrowing during low-rate periods can create future financial stress if rates rise later. Responsible financial planning remains important even when credit is cheap. 8. Inflation effects. Lower interest rates can influence inflation levels. As borrowing and spending increase, demand for goods and services rises. If demand grows faster than supply, prices may increase, leading to higher inflation. Central banks monitor inflation carefully when reducing rates. Moderate inflation can signal healthy economic growth, but excessive inflation reduces purchasing power. If inflation accelerates too much, policymakers may need to raise rates again. The balance between stimulating growth and controlling inflation is delicate. Falling interest rates are often used during periods of low inflation or recession risk. Understanding this relationship helps explain why central banks adjust monetary policy gradually. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.